You know, water is good for you. You drink a lot of it.
It kills you.
But too much of it, you'll die.
So that's a good point that, when it comes to personal finance, if some is good, more isn't always better. And
Or as Jerry Seinfeld's joke was when he goes to the doctor with a bad headache or something, it's like, doctor, work out the amount that will kill me and take it off a little bit.
And so, when it comes to diversification, the number of people who go, I'm invested in a global equities fund, let's say VGS as an example, it might invest in 3,500 companies, which might give the appearance of diversification, but actually they're all large companies. It's 100% equities, 100% large companies, 100% Vanguard, and those companies will broadly behave very similarly. So you're not actually getting that much diversification, even though you've got thousands of names in the portfolio.
Well, so just on this diversification thing, and it's a fascinating topic, within this, you purchase one, I don't know if we need to go there too much, but I'll quickly go for what you say. You could be like, yes, I'm diversified because I've got this ASX 200 ETF with all my money in it.
Yep.
Is 100% Australian shares good for you?
Probably not.
Because when you look at it, diversification, spreading all our risk in different pots is good. But if all the pots are Australian equities, if most of the pots are black holes and banks, if most of the pot or all the pot is in Australian dollars, you've got no diversification there. So I think it's a really good discussion. And so that's probably the number one red flag. These are probably in no particular order of priority, but it's transparency and diversification.
Yeah. So if I just come back to the 165 RSEs, so if you're trying to pick a super fund, you've got to hitch your wagon to one of them. At LifeShopper, we limit our list to the ones that manage $10 billion or more. And that's that amounts to probably 90% of the dollars, but about a quarter of the managers, or less than a quarter of the managers, maybe an eighth of the managers. So that's our first cull. And then you start looking at, well, what's the underlying products look like? What's the pricing look like? What's the service like? What's the track record like? And so having hitched your wagon to a trustee, you now have to make the biggest decision after you've done it. So, and your choice of which trustee will drive the structure of the fund and hence the amount of tax you're going to pay over your lifetime. So big decision.
Yeah.
Next decision is what's my asset allocation? Now that's a fancy way for saying how do I diversify my money across different classes? And asset allocation will drive 90% or more of the underlying returns. That is, it matters more how much of your money is in equities, how much of it's in Australian equities, much more than whether you buy Telstra or BHP. And so getting that next decision right, and that's really a spread across real estate, infrastructure, bonds, gold, cash.
Okay. Can I jump in there?
Sure.
Because this is a really good point. I'm on the cover. Well,
I'm
not on
man.
the cover of this one, but I've booked in my photographer in a month's time because I need a few weeks to lose a few kilos. We might be putting a photo of me on the front of Retire Right. But because this could be things, what to ask your financial advisor around the investment selection. What's the asset allocation?
Yep.
Those should be, if they can't answer that, run.
And how does it align with my risk profile?
Yes.
That's number one.
2, ask them what is the underlying investments of each of the allocations segments. So what are the underlying investments with Australian equities? Yep. Then what you could do, you could ask them within that underlying investment, what are the actual companies?
Yes.
Because any financial advisor or fund worth their salt can 100% answer those three things.
That's right.
So they could. So here's an example. So ask me the question, Vince.
Okay,
A little role play.
So what's my asset allocation?
Vince, in your portfolio, we've got 26% in Australian shares.
So what sort of Australian shares?
We've got 2 investments in the Australian shares. One of them is, and we'll call it 50% of the 26% or whatever I said, 30%, is an ETF that invests in the top 200 Australian companies weighted to the index. So it's an index approach. Mm-hmm. The other option is an active fund, and it could be insert active fund manager here, and they manually select Australian equities, and we can open the product and we can see their top 20 holdings. So that's very transparent, isn't it?
It is.
We've drilled down on, you've recommended me put my $1 million of super into your fund. Okay, you've said 30% of that, or 26% is in Australia. Within that, there are 2 options. One of them is Australian equities index fund, top 200. The other portion, probably not going to be 50-50 of the 25, but a small overall 5% of the portfolio is in an active small caps company.
Yep.
We use Ausbil, or who do you use?
Ausbil, OC, SGH.
Yep. They've been around for 30 years. They show you the top 50 holdings, or very transparent.
Yep.
Now, if a financial advisor can't drill down on that with the Australian equity allocation, the international equity allocation, at the very least, you need to contact me and I'll give you a new advisor.
Yeah, and in that vein, then if asset allocation is important, then consistency of asset allocation is just as important.
How often do you rebalance?
And many portfolio managers, in particular in the higher profile funds, will have wide ranges of possible. So they might say, we're going to put between 0 and 45% of this allocation into Australian shares.
And is that the strategic asset allocation?
So usually they'll say, our target is 25, but we have a possible range of 0 to 45.
So in the PDS,
that's in the PDS.
You will see words like strategic asset allocation,
or
tactical, or target.
Yep.
So basically, because throughout life, the Aussie equities might have a good run and it might increase from 20, but we know it's not going to be more than 35 at any one time.
Yep. And so focusing on the target can be a little dangerous, that you want the target to align with your risk profile. So if you're a balanced investor, your appropriate asset allocation might be 70%. So you want to make sure that your target in whatever you're investing in aligns with that. But if the spread is too large, you really want to look at, are they telling you how they decide where in that range it's going to be? Is it just because they want to be lazy about rebalancing it? Or do they take active positions and say, look, we think the US is going to do better than Australia, therefore we're going to have less in Australia and more in the US. That's called strategic asset. Tactical asset element.
Yes.
So you start with a strategic asset.
Strategic is, this is what we're aiming for.
And then you may move it up and down.
Based on the day-on-day tactics.
At LifeShopper, we're fans of fixed asset allocations, which we reset every quarter, so that you know that if you bought a 70% portfolio, that's what you're going to get. You may or may not get that in someone who does tactical asset allocation. And there's not a lot of evidence that tactical asset allocation adds value sustainably. Clearly, you can win from time to time, just as active managers can win from time to time. But in terms of sustainable differences, your target's what matters and the spread around that. So that's step number 2. And then the underlying that is, what's it actually invested? So I got my 20% in Australian equities. What's it actually invested in? And index is good.
Any financial advisor that we refer listeners to, I can tell you 1,000,000 times over, they can confidently answer those questions.
Yeah, and that's why on our LifeShopper Invest website,
Oh, you show
We
people.
show you what it's invested in.
You could copy
So
Vince's
you can copy
portfolio
my homework
yourself.
if you want. It's
Yeah.
not my portfolio, but our investment committee. You can copy our homework. And as I say, if you're going to copy, you should always copy from the smart kid in the class.
So diversification is huge
Yeah.
because then if, for example, if the portfolio had overall 5% to an active fund that was a little bit specky and that's why we only got 5% in it and it fell over, it's not a total flush.
That's right. And the other thing about asset allocation is these names are not necessarily legally defined.
No.
People use. So one of the things to look for, or two things. In terms of the headline 70-30 or 80-20, you need to look at how they're getting to that number. So many of our larger funds reclassify part of their infrastructure and real estate as defensive. We would add that back in terms of our analysis because that's a fairer definition of what's the underlying. And the problem is bigger on the defensive side.
Yeah.
So particularly as you get older, where you're going to have more and more defensive. The difference between fixed interest and credit sounds the same to the man in the street, but they are wildly different things. And many credit funds...
We don't like credit, do we? We don't mind fixed interest.
Yeah, but credit can be very opaque. It's very hard to assess.
Yeah.
And a lot of it's not particularly defensive.
Yeah. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.